Hello, everyone. Today I'm joined by Wesley Tillu, a partner at Section 32 Ventures. Hey, Wesley, where are you dialing in from today?
Hey, Julian. Nice to meet you. I'm dialing in from San Francisco today.
Is that where Section 32 is based?
Yeah, so we have our offices down in Palo Alto, right on University and High Street, right in downtown Palo Alto. And we're have a hybrid approach. So it's 2 or 3 days in the office and then the rest of the week up in the city in San Francisco. We also have some office space at the Ferry building in a co-working space called Shack 15. So between our Palo Alto headquarters and the city, we are covered across the Bay Area.
Nice. Very Bay focused. Well, I'm so glad that you joined the podcast. I'm really thankful for it. I think it will be a great episode. Before we dive into the nitty gritty of your day-to-day job in investing, could you first describe in simple terms what is Section 32, what kind of investments you make in both sector and stage?
Yeah, for sure. So Section 32 is a venture firm that invests at the frontier of technology. And the ultimate mission is to find technologies that can improve the human condition. Our fund was founded by Bill Maris, the founder of Google Ventures, and he started and grew Google Ventures to one of the most active venture investors on the planet. He, during his time there, had over 150 exits. He invested in over 50 companies that would become unicorns. And in 2017, he decided to start his own venture firm. And Fund One was really backed by his peers in Silicon Valley. And he quickly invested that and was very successful, and then decided to raise another fund and another fund after that, and so on. So 7 years later, we have over $2 billion in total assets under management. We're currently have over 100 portfolio companies and investing out of our fifth fund and across really the software stack. And that includes anything from AI to cybersecurity, all the way to infrastructure software, data and dev tools, and anything B2B software related. We also invest across the vertical. So healthcare is a vertical, as well as cybersecurity and other types of verticals as well.
Great. And I know everyone sort of has their own path to venture. It's very varied. So could you just walk us through how you ended up at Section 32? You went to Wharton, but everyone kind of takes their different routes. So we'd be curious to sort of hear your route into VC.
Yeah, for sure. So I was born in New York. I grew up in Singapore and studied engineering at college at Cornell. And during that time, I really wanted to go into the finance industry. So I started my career in investment banking at Merrill Lynch, where I focused on M&A and equity transactions for Fortune 500 companies in the industrial space. And then I wanted to go on the buy side and work as an investor. So I worked at GIC, which is the sovereign wealth fund of Singapore, and was on the direct investments team, executing and helping make transactions across the different verticals, including internet, healthcare, and retail. But I really wanted to get operating experience after that to complement my investment skill set. So I went to Wharton and got my MBA. I majored in entrepreneurship and actually worked on a couple of startup ideas on my own. But I decided when I graduated, I wanted to join a larger company in technology that was working on scaling and already had a product platform in place with lots of users. So I decided to move to San Francisco and I joined Google, where I managed partnerships and operations for a couple of product teams. Most recently was Google Express, which is Google's e-commerce platform, and help it grow over 20-fold in terms of the partner ecosystem that they worked with. And from there, I really wanted to go back into the investment side. So I looked across the venture capital industry and then ended up finding a role at In-Q-Tel. In-Q-Tel is the venture capital investor for the U.S. intelligence community and the CIA. And there I invested in just about 20 transactions, sat on several company boards, and it was a great experience for me. And after a few years there, I got a call from Section 32 and Bill Maris and Andy Harrison, our CEO, to join them on their journey. They're looking for the next generation of leaders. And I decided that culturally, it was a great fit. The team was stellar. They had a really great track record, and I could continue to pursue investments in the areas that I was very interested in, including artificial intelligence, machine learning, cybersecurity, and broadly enterprise software. So I've been there for about 3 years now, and I'm currently a partner here, helping drive our investments across the technology software landscape.
Super interesting. And I'm definitely very curious about the In-Q-Tel experience. So I know I have some more questions later in the podcast that we'll sort of find ourselves back to, but it's impressive how you have both the investing, banking, and operating experience. I feel like that's the trifecta to go into venture. So cool to see that you have all three. I now want to change gears and actually start talking about your investments and where you actually focus on at Section 32. You mentioned that you're really interested sort of in the machine learning, deep tech, AI space. What originally drew you to that? Did you sort of have experience? You mentioned you were in the industrial space and banking, so a little bit different, I guess, from deep technology. So curious how you sort of thought about that transition and what attracted you to that space.
Yeah. So while I was in finance and on Wall Street, I was very interested in the startup world, and I was always interested in new technologies. I found myself going to the New York tech meetups, meeting founders and entrepreneurs and understanding the latest technology. When I got a chance to go into venture, I really wanted to focus on the most cutting edge technology and the latest in terms of the frontier of what is going to propel a lot of the companies going forward. And I thought that artificial intelligence and deep technology really is a foundational transformational technology that will affect companies for the decades to come. And in 2017, the Transformer paper from Google was published and was foundational to a lot of the large language models and the machine learning systems that we're seeing today. So I think just being around the ecosystem and technology and at Google when a lot of the foundational technologies were developed was very exciting for me. And I think these areas are hard to understand. They're deeply technical and it requires time. And I thought that if I could invest in learning from the best investors and from the best operators, now it will accrue in value. And over time, whether that's 5 or 10 years later, I can have developed a deep understanding of these technologies. So I think the fact that it's transformational and foundational for a lot of startups to come, and also that it was a challenge for me to tackle. And it's hard to understand, but I like that challenge. And that's what drew me to more of the technical spaces in AI and deep tech. And I am an engineer by education, so I do like to dive deep into the actual technology and the software underneath the applications that we're seeing.
I think it's a great segue that you mentioned the Transformers paper, because I think the AI space is really interesting, I think, from the perspective of who's going to be the next dominant player. Because I think right now in the current tech environment, we have 3 incredible incumbents in Google, Microsoft, and Amazon, especially when you consider sort of their cloud businesses and the distribution advantages they have in relation to that. And as you mentioned, Google published this Transformers paper in the 2010s, yet they almost were kind of on the back foot when it came to this most recent wave of LLMs in the AI space. So I'm kind of curious, A, why do you think Google ultimately kind of was on the back foot and created an opening for players like OpenAI, Anthropic to come in and sort of take market share or become leaders in the LLM and AI space? And do you think that eventually, because of their distribution advantages, that a lot of the value in the AI space will ultimately kind of fall back to those 3 sort of large incumbents, and maybe we can include NVIDIA and Meta in that incumbent space?
Yeah, it's a very good question. I think as it relates to the first part of why Google, that had a lot of the foundational technologies developed in-house, saw a lot of competition from OpenAI and third parties. And I think it points to a few things. I think first is the innovator's dilemma of they are the incumbent in the space with so much resources, and they have a very sustainable business model, which is ads driven. And so understanding what can drive the business forward, but also maintain their existing foothold in terms of revenue was likely important for them. I think startups have several advantages. First is they can iterate much more quickly and they can get quick feedback. They can get products out quickly and then make improvements and leap much faster than others. I think the second is often customers, they are able to, if they have a niche in terms of the customer and distribution that perhaps big tech doesn't have, that's one that startups can really get advantages with. And then I think third is really how fast they can move, but then also the technology piece and the customer piece. I think it's all just combined into one. So yeah, that's what I would say about that.
And do you think going forward, OpenAI and Anthropic will continue to sort of have this edge and be sort of those disrupting players, or the fundamental like distribution advantage? Everyone has Copilot now on Office 365 just because of the nature that Microsoft is basically in every single enterprise in America, which gives it a huge advantage in terms of getting its products there. And I know they made the partnership with OpenAI, which kind of, somewhat, I guess, blunts that incumbent advantage, or maybe not blunt it, but shows the power that the disruptors have. But I'm just curious where you think that value will ultimately accrue in the future.
I would say we think of the AI technology landscape as a stack of technologies. At the base, you have the hardware providers, GPUs, NVIDIAs of the world, powering a lot of these compute use cases. And sitting on top of that, you have the foundational model layer companies, and that includes OpenAI, GPT models, Anthropic, Claude models, and Google Gemini, and also open source. And then you have, on top of that, some of the tooling and infrastructure that it's needed to deploy some of these models into enterprises and applications. And then sitting on top of that are those applications across the different verticals. So I think if we're looking at the foundational model layer, our view and my view is that it is a few winners take all type of market. It was incredibly capital intensive to train a lot of these models, and hundreds of millions and more to train these models. And it really was a race to get to the point of where they are right now. But I think people like flexibility. They don't want vendor lock-in, whether that's putting only all their workflows and workloads into Google, Amazon, or Microsoft. People also like kind of innovation. And as I mentioned earlier, some of the OpenAI, Anthropics of the world, they can potentially iterate more quickly. And I think the third is, yes, that a lot of the cloud providers do have existing distribution, but a lot of these companies are opening up new markets that didn't have reach yet by the cloud providers. And a lot of AI is disrupting, for example, human services, replacing humans that might have not had software there before, where Google and Meta and Amazon were not distributing to before, that potentially an OpenAI or an Anthropic could thrive. And I think ChatGPT really opened up the world of what is possible with AI for these enterprises. So it was launched in 2022, and 2023, I think, was the year of enterprises really being very excited about potential AI deployment. So a lot of budgets were carved out for pilots and prototypes within the enterprises. And then this year, a lot of people were expecting, well, maybe some of these prototypes would go into production. I think we're still in this phase of prototyping, but perhaps next year we're going to see lots of real world deployments. And again, because a lot of these companies were excited about what OpenAI had launched, they're working with some of these more innovative players up front. But I do think that Google and others are catching up very quickly. And ultimately, it's going to be a few winners to take all market, and we'll see where it goes.
A lot of the prior quote unquote industrial revolutions have been linked to basically a distribution revolution. The steam engine made it cheaper to get goods. Electricity then made it even cheaper to sort of bring goods to people. The internet now allowed you to buy services from across the world in a much easier way than before. Do you think AI has the same sort of distribution revolution that those prior sort of industrial revolutions had, and therefore will kind of make it the value creator that the internet was for the last 20, 30 years? Or is it more sort of like a semi-revolution in that sense, where it's an accelerant of the internet revolution, but not maybe a complete net new revolution?
Certainly, I think AI is a revolutionary technology. It's really foundational and fundamental to driving lots of real world applications and improving the efficiency and productivity for the world. We actually view it as an analogy is AI is the pie pan, and the pie itself are the individual slices and verticals, whether they are in cybersecurity or enterprise or healthcare. It's really the foundational layer that drives a lot of the applications that we're seeing here. So as we see that most software companies are going to be AI companies, and most AI companies are going to be some sort of automation and agent type of application on the way to AGI or artificial general intelligence, right? So we are still early days in terms of the potential for AI. And I think because of that, to answer your question, I do think it's really revolution and foundational. And this is on the way to potential, the AGI that people are talking about, but we are still a ways away.
Yeah. It's so impressive that we're still in the early stages. I think that's sometimes like hard for people to grasp, is that like you look at ChatGPT or Claude or pick your LLM of choice, and it's quite impressive. But I think for a lot of people working behind the scenes, they really realize there's still a lot of juice to be squeezed from this, which I think is really exciting. I now want to change gears a bit and sort of talk about a specific investment that you've made, sort of like at least in the AI adjacent or AI application space. I think a lot of people have an understanding of AI as being solely LLMs, but I'm kind of curious about some of the other applications and sort of businesses that are arising because of it. So I want to double click into your investment into Tollbit. Can you kind of walk us through what Tollbit does, what made you particularly excited about the investment, just to kind of help people understand a little more of the ancillary businesses that are happening around AI and some of the other additional applications that are kind of coming out of it?
Yeah. So we have invested across the AI stack, as I mentioned. We invested in a foundational model layer company, infrastructure and tooling, and several applications. And I think the next step with a lot of AI companies is a lot of these companies are going to become AI agent companies. And that means they can not only do one-to-one tasks, so you ask a question and they respond to you. These software companies can take several tasks and take several steps. So assuming that this is where we're headed, we are evaluating investments, kind of second order effects of AI and AI agents. And one of those effects is in terms of how people search and get content. So currently, you go on Google, you go to search engines, and you go to different websites. And a lot of these content producers are monetizing their content through ads. However, in a world of agents, which means you're asking an AI system do the work for you, you might ask them to book a flight, maybe do research for a certain trip. They need to go out there and go on their web, these agents, and visit the different websites. But because these agents are not human, they are providing the eyeballs and the clicks for the ads that will then publish and kind of compensate the publishers. So there's two worlds here, right? One is potentially a world where if these publishers are not being compensated, there could be a quote unquote balkanization of the internet where everyone owns their own publishing data and they don't want to share it because they're not getting compensated. Or the second world is one where things continue to be open, but there's a new business model. That kind of tees up our investment in Tollbit. So Tollbit is an AI content monetization platform. They work as a two-sided marketplace, and they work with both publishers of content. So think New York Times, Time Magazine, Fortune, Forbes, etc. And they help them monetize their content to AI search engines. And these AI search engines are potentially, for example, ChatGPT, Perplexity, U.com, and others. And currently, there isn't a real scalable way to compensate a lot of these publishing companies. So, for example, you see in the news, New York Times had to strike a direct partnership agreement with OpenAI for their content. But there is a medium and long tail publishers that potentially won't have these partnership opportunities. And there's also a medium and long tail of AI companies and potentially AI agent companies that will be using this content. And then we need to match that up and provide a way of monetizing and compensating the publisher. So Tollbit is really the infrastructure to charge tolls, quote unquote, to the AI users, which are the search engines of this content that's on the internet. And we were very excited for a few reasons here. One is the team, they were building product and engineering at Toast, and they really had a strong vision for the future and also just really good technical chops. We're very fascinated by the market opportunity because agents are the future of internet traffic, and is there a way to compensate and monetize? And that was very exciting for us. Third is that they were already in conversation with many publishers. I think today they have over 200 publishers on their platform already. And then they're already working with some of the AI systems to help foster this relationship. So the early traction, the team, and the market opportunity were all very exciting. So we ended up investing in the Series A most recently, and think that there's going to be more and more use cases going forward, because not only AI search engines, but also agentic AI companies across legal, cybersecurity, customer support might all be using some of this content that's on the open internet and would want to fairly pay for the content that they're using.
Yeah, that's fascinating. I mean, a lot of people talk about the proverbial picks and shovels of every industry, and that definitely really feels like a real pick and shovel sort of AI in terms of supporting the infrastructure around it and the business models of other companies. So that's quite fascinating. You mentioned the team, and obviously founders and teams are a really important part about venture investing. And so I'm kind of curious of how you started building that muscle of understanding and identifying who's a good founder versus who's not a good founder. I imagine your work with GIC, very different businesses. Obviously, the founders are maybe no longer there of the businesses that you're investing in, or it just fundamentally looks different and you evaluate the business in a different way. I'm curious how that process was at In-Q-Tel and then now at S32 of sort of generating that muscle and being able to identify who is a good founder.
Yeah, it's a good question. I say a few things. I mean, the first is we, as a firm at Section 32, we take a very data-driven approach to investing, and we have a head of data who is the head of data at Google Ventures and really trying to understand the metrics and history of what drives a good return. And I think as it relates to the team, we figured that repeat founders tend to outperform first-time founders. So a second-time founder that has had an exit that's above a certain amount, but also just generally a successful exit would outperform a first-time founder. A third-time founder might outperform a second-time founder if they had a couple exits as well. So the number one thing for us is just experience and having founded something in the past. And that's a really good indicator for us. I think there's a couple of paths. So one is, yes, if you are a former founder, that's great, but that's not necessarily the case. I think the second thing is having a unique market insight. And that often comes in the form of someone that has operated in that certain industry. So if this company is a developer tool and the founder himself or herself was a developer and they had to build some scaffolding or some tooling to help them with their job, and now they're saying, I want to bring this to the world, that is a very good experience and a moat that's defensible. For example, one of our portfolio companies, Phaedra AI, offers an AI platform to help optimize energy consumption for data centers. And Jim worked at Google DeepMind, helping Google in a pilot save 30 to 40% of their data center costs from the energy consumption through their platform. So having lived that experience at a larger company and leaving to start their own company around the same insight, I think that is also really important for us. And ultimately, it's also about the vision, and aligning with the vision with the founder is very important of where you think the world will go. For example, is it going to be an agent-led world where publishers want to get compensated by AI companies? Yes. In which case, then can we find a company and a CEO that aligns with that vision? Those are the things that we look for. I think there has been an evolution of the type of founder as well. I think in AI, for example, a lot of the companies that were funded a few years ago were AI researchers. They're coming from Google's and Meta AI teams, or maybe universities and PhDs in certain AI fields. And as we've moved on, I think there's been an evolution where rather than just understanding the technology, you want to also be able to understand the market and what the business needs. So we're seeing profiles that have evolved, maybe initially were AI researchers or engineers, to today we're seeing product managers, potentially sales and marketing professionals, or folks that were in growth, really that understand how to grow a company from a technology that could be very technical and difficult to consume by enterprises into a layer that is very easily digestible by business users. So we are seeing that some founders that have that insight from the go-to-market side are very interesting for us as well.
Do you still require sort of a technical co-founder though, especially in these very technical businesses? Is that basically a requirement for you?
I would say that, well, it really depends on the company. If the company where is a technology where the moat is around your IP and the technology that you are building, then it does make sense to have a technical co-founder, right? But if the moat is really around other things such as a customer insight or potentially a data moat, or you just have a really strong viral component to your product, maybe it's a product-led growth company, then potentially there isn't as much of a need for a technical co-founder. I think I always say that a founder can, if they have a unique insight, they should pursue it, and they don't necessarily need to find a co-founder or force themselves to work with a team of 3, for example. But if they find that they hit a point where maybe that the product differentiation is around the technology, maybe there's a very unique way of using AI, then perhaps it does make sense to have an AI researcher or an engineer to partner with. To answer your question, I wouldn't say it's a requirement, but it depends on the type of product you're building. So for example, we're investors a lot in cybersecurity, and in the cybersecurity industry, the founders that we see have built several companies in the cybersecurity space, and they've been chief security officers potentially for years, or security researchers, because that technical expertise is what's required. But other industries, maybe you don't need as much of a technical experience in that sector.
And I want to pivot to the way Section 32 sells itself in these deals. Obviously, you guys are investing in a lot of AI startups, which is obviously a very hot part of the VC ecosystem. So I'm curious, how does S32 really sell itself to win deals? Is it making a relationship with the founders early on, or are there aspects of your platform team or the support that you provide post-investment that you think differentiates S32 from other funds?
Yeah, several things and several ways that S32 differentiates itself. I think first is the team. I mean, all of us have been operators in the past. Many of us came from Google, and several of our general partners worked and led public companies. They sold companies, and Bill himself grew Google Ventures from inception to what it is today. So just having built something is a very strong selling point. I think the second is that we are technical investors. So we do like to dive deep into the company and understand the technology. And often founders do want to just have investors that understand what they're building and what the architecture and their approach and how that is resonating with the companies, with the investor, is really important. So I think just understanding technology and being technical investors is another category. We do have a very strong platform team. So one of the parts of that is our head of talents, Alice. She actually came from Google. She was the most prolific recruiter at Google, having built several teams from scratch. And we brought her in-house to help our portfolio companies and new companies build talent pipelines. So that's been a key selling point. We have a head of data who is from Google Ventures. Also, as the head of data, we have a head of marketing who led marketing both at Android and Uber globally. And all of us have various touch points for go-to-market. And we have a increasingly large operator network and strategic partner network that we can introduce customers potentially to our companies. And yeah, I think that all those things combined make us win deals. It is an ultra competitive environment, so you need to have everything aligned. And I would say also that we are all willing to work. We recognize that we were founded 7 years ago and wanting to partner closely with our CEOs, and we have helped them strike partnerships, get new customers, work on sales strategy or pricing strategy, all those things. And being very close partners is a very important part of our value prop as well.
Yeah, it's super fascinating because I feel like it is one of the most challenging things that people don't think about when they think about ventures. At buy side, everyone's going to want my money, but there's a lot of dollars floating around the VC ecosystem, all chasing the same set of companies. So I'm always curious to hear how people think about it. The next thing I want to talk about is a little bit your experience investing at In-Q-Tel versus S32. Obviously, as you mentioned, In-Q-Tel is investing for government agencies, in this case, intelligence agencies. Very different sort of LP, quote unquote, that you're representing and strategic narrative that you're representing with In-Q-Tel. Could you maybe just walk us through sort of what are maybe some of those main differences in terms of representing the government versus, in this case, being more private investors? Did it have any sort of limitations that were in some cases challenging or annoying, or did it kind of bring some other unique benefits to it?
Yeah, it's a good question. So In-Q-Tel, as I mentioned, is the venture capital investor for the CIA and the U.S. intelligence community. It was founded over 25 years ago, and its mission is really to bring technology and capabilities to the U.S. government and intelligence agencies. And I'd say there's a couple ways you can look at this. First is, as you mentioned, being a strategic investor versus being a financial investor. So at In-Q-Tel, our mandate was really to identify technologies that could be strategically useful to the partners that we were supporting. So that was certainly number one. And at Section 32, we are financial investors. So we are ROI driven, meaning we want to make sure that we get a financial return coming out of it. And we don't have strategic partners, for example, as stakeholders here, right? It's all financially driven. I'd say that that's one of the differences for sure. I would say at In-Q-Tel, we also, because it takes time to develop relationships with the partners and to make sure that the use cases are aligned with them, it potentially could take more time. But that's okay because once a customer is identified for the startups, the government partners tend to be very loyal and sticky. And I think on the financial investment side of where I am now, markets move very quickly and deals could potentially be done, if not weeks, in days, and even potentially 24 hours. So there's certainly a timing component to all this too. But I think ultimately, though, as a strategic investor, you do want your investments to do well, because if the government and partners are consuming the technology, you want them to be around in 5 years, or you want them to be around for a long time. I would say the similarities are ultimately you want to invest in good businesses, because on the strategic side, the capabilities will hopefully endure and last for a long time. And then on the financial side, the better the business, obviously, the better the outcomes and financial returns on behalf of our LPs. So there are very much strategic alignments there. And I'm super grateful for my time in In-Q-Tel. It taught me a lot, and that's transferred and translated very well to what I'm doing today.
Amazing. Speaking of career journey, I do want to spend the last couple of minutes of the podcast, given that we are an MBA podcast, talking about career advice and general advice, I suppose. VC is obviously a difficult industry to break into. In some sense, there's just a very limited number of seats, which makes it somewhat challenging. I guess the nice thing is that you can come to it from multiple different types of backgrounds. But if you had to give one sort of piece of advice to break into the VC industry, what would it be?
My advice would be to come up with a thesis, develop a presentation or a deck, and towards the end, pick a few companies that you think could be very interesting for whatever VC firm that you're talking to, and potentially that you can pitch those as an investment. So I think it's very important to show that you can do the job, and also come with some sort of value proposition when you approach a VC. So, for example, if you're very interested in AI and cybersecurity, or if you're very interested in foundational model companies that are going to be the next generation of OpenAI and Anthropic's, you can take that as a thesis and develop some material to present to the VC, and then ultimately pitch a few companies. And it'd be even better if potentially you're already in touch with the CEOs of those companies, and you can say, hey, I can make those introductions for you. I'd say that that's very important, because it's an ultra competitive environment, and often people take the first step of, and I think the first step is to network with your peers at Wharton. There's lots of foreign alumni across very strong VC firms. But then the next step is then to say, okay, I can already do the job by sharing insights and giving them some materials for them to take away, and they can see that you can already do the job. I'd say that's definitely the advice I'd give. And hiring in VC, it's very ad hoc, I would say, because every firm is quite small. So one hire really affects the culture of the firm and also the operations of the firm. And so my typical advice is just focus on initially companies that have outwardly said that they are going to hire. So look on job boards, go through VC newsletters, and just find the companies and approach them, and try to get an introduction from maybe an alumni that works there, or a friend that knows a partner there, for example, and then go from there. Obviously, you can broaden that out to VC firms that aren't hiring, or maybe don't have a public posting, but I definitely start with the first bucket to be most efficient with your time. And then ultimately, the third thing is go to events, go to tech meetups, because Silicon Valley and VC is all about who you know and networks, because that often drives a lot of deal flow. And going out there and meeting entrepreneurs and CEOs and also other VCs in person is something I definitely recommend as well.
Yeah, super fascinating. I think the advice that you mentioned around sort of doing the job is definitely something that I've heard a lot. So I think it's good advice for a lot of the people listening who do want to end up in the VC space. The final question I have is, what is the best piece of advice you've received in general, VC or non-VC related?
Yeah. Okay. So I'd say a couple things. I mean, first is, in VC specifically, is to be patient. So VC is a very long game. I came from private equity, where maybe you're modeling out returns for 3 to 5 years, but in venture, exits might take 5 to 10 to 15 years potentially. So the day-to-day feedback loop isn't really there. It's not like, all the way to the other extreme is a hedge fund where you see your positions moving daily. And so you're not going to get that in venture. You just have to be ready to sit through cycles, and maybe companies take 2 years to understand their go-to-market strategy, but finally something hits and they really accelerate their growth. And sometimes it might take 5 years and sometimes it might take 6 months. So it really depends on the company. I'd say that's on the VC side. I think non-VCs, you don't get what you don't ask for. So I think if you are interested in something, if you're talking to Wharton alumni and asking, hey, is there any job opportunity or is there a way that I can work with you? Kind of asking those questions and demonstrating your interests often leads to more outcomes. And if they say, you know what, actually, we don't have anything open, but I have 3 other friends that would love to talk to you. Just being able to open doors and not being afraid to ask is something that has been important. And I tend to keep that in mind as well.
Great. I think that's a great note to end on. Thank you so much again for your time, Wesley. I really enjoyed the episode and recording this, so I hope the audience does too. And thank you again for your time.
Awesome. Thank you very much.